Welcome to Coleman Report Live. I'm Bob Coleman. We're talking Main Street and the small business lender who helps it grow. Lance Sexton, John Winning. Gentlemen, thank you very much. And Delaney Sexton also will be coming on to talk about Fraud Friday. But first, I wanted to invite John. Anything going on in the markets these days that we need to be aware of?
Loaded question, Bob.
Yeah, I mean,
John, you got 45 minutes. Go.
Sure. I mean, this has been the most abrupt shift in interest rates that, you know, anyone who's less than 60 years old can probably remember. I don't know what it was like in the early 80s.
I was going to say I can log on to you.
But it's happened very quickly. I used an example in my blog yesterday. A $570,000 loan at 3% has basically the same monthly payment as a $400,000 loan at 6%. So you can see what a big difference the abrupt increase in interest rates is making. You know, it's causing a lot of disruption. We're seeing it firsthand in the mortgage market. I'll give you an example. Back in January, you know, Fannie Mae rejects or agency reject mortgages. So we're talking 70% LTV pools, 730 FICO scores. We're trading in the mid-90s. And those pools are now trading in the low 70s. The residential mortgage market is in a state of collapse, really.
Do me a favor. There's someone who didn't understand what you said. So when you say they trade in the mid-90s and now in the mid-70s, what does that mean?
Yeah, so par being 100%, loans that were trading in the mid-90s, so a slight discount, probably because of underwriting or some reasons they, you know, you probably call them scratch and dent. Those same loans are trading in the 70s.
So 30% discount.
You know, and it's not completely rational. Obviously, a 3%, 3.25% coupon versus the prevailing 6% coupon does merit a discount. But there's all these banks, all these mortgage companies that have loans sitting on their balance sheet in the threes. They're stuck with those loans. Those loans aren't going anywhere. People are not going to want to refinance a loan, you know, with a 3 handle for a long time. So, you know, that's causing some disruption. You know, we're having a more difficult time getting banks and credit unions and so on to buy good loans. You know, we're still getting them done, but their yield requirements have gone up, and there's just a lot less of them. More and more, we're calling people, and they're telling us, well, we're not a buyer right now, we're a seller. So, you know, we've gone from a period of incredible liquidity. The mortgage industry had its best run ever, and now, you know, we're unwinding that. So it's going to be an interesting next couple of months for us.
John, how is bank profitability doing?
Actually, the bank side is looking really, really good. The banks were operating at record low net interest margins earlier this year, and there was I think a 26 basis point increase in net interest margin in the last quarterly banking profile. You know, really anyone in the banking industry should read the quarterly banking profile. FDIC puts it out. It covers every single U.S. bank. They also do a segment on community banks, so you can see how community banks are doing relative to large banks. So, you know, margins are looking great for banks. They're flush with loans right now. So, you know, the asset liability picture is changing. What you're seeing is deposits are running off. So deposit balances are decreasing while loans are growing. So banks are definitely less liquid than they were recently, and that's obviously causing some other challenges.
Well, John, we'll send that out. We'll do that as an attachment to everyone on Monday. Hey, you made it. You picked up the American Banker article, and I want to talk about this. This number of banks have halved in the last 10 years, and where do we go from here? First of all, what does that mean for us personally if the number of banks have been cut by 50%? And what about banking as a profession in the future?
I mean, I think it depends on which market you're in. If you're in a place like Chicago, there definitely seems like there's still way too many banks, and there's no evidence that consumers, businesses don't have an adequate amount of choices. I do think when you go into some smaller communities, the loss of community banks is, in some cases, can be quite devastating. Having said that, when I was starting in this business, there were 8,500 plus banks, and banks would tell me they're loaned up, and now there's half as many banks, and I still talk to a lot of banks that are sitting on, very low loan deposit ratios. So I do think the consolidation of the banking industry will continue. Certainly that will cause some friction. But I don't know. I necessarily don't think the employment for banks is going to go down necessarily.
Yeah.
I mean, it's a healthy sign that there is demand for community banks, and I don't like to see too many disappear. So I am concerned that we're losing a lot of good community banks, but I do think it's going to kind of slow down. I mean, the banking regulators do not want any more mega banks. You will not see U.S. Bank and PNC get together. You're not going to see, Zions and Wells get together. They seem to be wanting to stop any more banks from becoming too big to fail.
This professor out of Florida says that he expects, he said there are fewer than 1,000 banks with less than $100 million in assets. Most of these will disappear. Do you agree with that?
I don't know. I mean, I think it's, it's like that line, old soldiers never die, they only fade away. I'm quoting MacArthur. I mean, I think, those banks will exist so long as they have local ownership and they make enough money to generate some return. They may underperform, but so long as their local ownership is satisfied, it's hard to say because, every bank is different and dependent on their shareholder base. Do the kids want to be in banking? I mean, that's all often a factor. Is the board of directors, they have any young directors, they have any young management team? Those are other factors that are hard to assess.
John, this economic turndown, where I have a difficult understanding is unemployment. 10 years ago, unemployment hit double digits. Here we're still seeing a recession. California, we're at 4% unemployment. Nationwide, I think similar numbers. Tell me about that. Well, I don't understand the dichotomy between rising interest rates and seemingly stable unemployment.
Well, I mean, it's sort of a good problem, bad problem, right? Because unemployment is so low, it emboldens the Fed to keep raising rates. It does seem so far that the rate increases have not really changed the employment picture. So I think that, look, eventually these rate increases are going to kick in and they're going to lead to layoffs and they're going to lead to higher unemployment.
Got to ask the question, and I'll let Lance chime in here. How high are we going?
I mean, I've been saying the 30-year fixed rate's going to go to 8% for about 6 to 12 months, and people thought I was crazy, but we seem to be...
Your housing rates.
Yeah, I mean, we're already at, almost in the mid-sixes on 30-year mortgages right now for the average. Look, I think they will go as high as they need to get inflation under control. Until we see a meaningful reduction, if you can get inflation below, say, 5%, and you get evidence that the economy is slowing or entering a recession, then I think the Fed will probably just stop and see what happens. Yeah. But, it's tough to turn this boat around. I mean, I included in my band report some anecdotes on what Paul Volcker went through in the 80s. I mean, it was pretty tough. I mean, there was protests and, people were not happy with the Fed raising rates into the high teens. So
Lance, I'll ask you the same question and give it the SBA spin on it. How high is prime going to go, and how concerned should we be about our portfolios?
Well, I think there should be a great level of concern for your portfolios because most of the loans were underwritten at a time when a normal SBA rate was 5.5%, 6%, and now a normal SBA rate's in the 8s, possibly touching 9. I think rates are still going to go up. I am hopeful no more than 1% more. But it's like John said, inflation's got to slow down. We have to see the economy slowing down in order for rates not to continue to increase. We've lived and seen rates much higher than this, Bob, but I was talking to a young group of bankers and trying to explain how it was in the old days when an SBA loan had a 21% rate. And I go around, most of those people were not alive when that happened. So I am very anxious about portfolio performance in not just SBA lending, but commercial lending, because these small businesses that can pay their payments right now we've had a 50% increase. So when those payments reamortize, it's like John was sharing a mortgage example. SBA borrowers, are having very significant payment increases when the loans reamortize. So the question is, how will they perform at that point?
So I can't get either of you to go on the record on how high we're going to go. I'm not going to go on the record. Just
yeah, I mean, as I said before our call, the payments on a $570,000 loan at the old 3% rate are the same on a $400,000 loan at 6%. So what I think we may see happening is the rate increases are going to freeze purchases. People are going to be reluctant to sell their building, pay off the loan they have now, hopefully it's fixed, and then go buy a building and put on 7-8% money. I think that's going to be.
Well, John, a perfect example. I bought a house 2 years ago. I've got a 30-year fixed rate under 3. There is no way I'm going to keep that loan.
But it's a term.
And that's why the housing market, could stay more stable, or it may be a very slow decline, because you have all these people that are like, I'm not selling my home to trade a sub 3% mortgage for double that. So, I think what tends to happen is, at least for a while, things just sort of freeze.
Yeah. And like I said, from an SBA lending perspective, I don't think it's going to stop borrowing, but it's going to require lenders to keep a much closer watch on the portfolio that they have.
John, you wrote that loan growth was basically 12% this year. What do you see next year, the demand and supply issue?
I mean, I think I think there's loan growth built in for the rest of the year. I think you'll continue to see strong loan growth through the end of this year. But I do think things will start to slow down next year. I could certainly see underwriting standards at banks tighten and make it more difficult to make new loans.
John, go ahead, Lance. Let you finish.
I'm sorry, from an SBA perspective, my good friend and my boss, Chris Hearn, said this in an article the other day, and it's true. Every time commercial lending institutions tighten their standards, SBA opportunities increase. So
that's definitely true. SBA has always been countercyclical.
Let's bring Delaney in real quick, talk about our cases for Fraud Friday. Delaney, are you with us? Hey, there she is.
Hello.
Hi, Delaney. What do you got for us this week?
I have a few fun stories. Starting off with this one, Mr. Todd recently received over 50 counts on an indictment for a $27 million fraud scheme. About 12.5 was in PPP loans. They stated that in the applications, he allegedly was making false and fraudulent claims with supporting documentation and applications that were falsified. In addition, he claimed he had employees who either never existed or had previously been fired or left. and he managed to obtain 12 million. Another aspect of this, which I wasn't able to get into too much, he had some loans with another bank. There were many promissory, am I saying that correct?
Promissory.
Promissory, thank you. Promissory notes. He was not paying his balances, and eventually he allegedly used some of the PPP funds to pay off those balances.
No. What's he driving?
You know, I'm not sure if there's actually a car in this one.
All right, a lot of money. How much did the government recover? Do we know?
Well, this is an indictment, so I'm not sure. I know that they're able to, I don't understand the legality. I think they can make him forfeit in the time being his bank accounts and whatnot.
Oh, they will seize all of his bank accounts. So most of the recovery will come from that.
Yeah, very good. Who's up next?
All right, now this one is one we talked about much earlier in the year. He got a pretty hefty sentence, 10 years for $31 million. He applied for quite a few PPP loans, a couple EIDL loans, and obtained $2.4 million. Similar story with the stolen identities, tax returns, falsified financial records. And this time we do have a car, a Tesla Model 3. I'm not so sure which one that is. Do you know?
It's a nice car. That's all I know.
Yeah.
Okay, yeah. Along with that, he did many transactions across about 43 different cryptocurrency options. He also paid rent, hotels, dog boarding, attorney fees, electronics, and many other personal expenses with this money.
That's pretty hefty, Lance, from what we've seen.
Bob, the big mistake I see here is buying cryptocurrency.
Well,
my personal experience with cryptocurrency has been very ugly. No.
John, Lance lost his 401k in crypto. I mean, you lost, how much did you lose, Lance? The whole 3 digits?
A whopping $850. No.
Well, okay, you survived.
John, I decided to have an experiment in cryptocurrency because I didn't understand it. And then I proved to myself, I don't really understand it.
You're not the only one.
And our final one, Delaney.
So this is the bigger Fraud Friday story. Mr. McKnight got about 2.5 years. He is apparently a pastor, mortician, a restaurateur, and a tax preparer. So he's got quite a list. I've been unable to figure out how truthful those all are. I'm getting some mixed signals from various sources. But he got caught up with some EIDL loans, ended up purchasing, hang on, I gotta make sure I get the car right, a Mercedes-Benz S-Class sedan.
Very nice. So
now he has to give back the $150,000 in restitution along with his
what was his sentence that he received?
I believe it's 2.5 months, or not months, years. Months would be a little short.
There we go.
Yeah, so then Delaney, this guy can feed you, save you, and bury you.
Yeah.
And he has death and taxes covered, Lance. Yeah.
Yes.
I guess the good news here is these bad actors are getting justice. So
they're getting justice, and we're recovering a lot of funds, John. Also, I mean that's the thing there. The government's moving very quickly, and they're seizing it. We had a story a while back where the government, he invested wisely, and the government got all the money back plus a profit. He still went to jail. Real quick, Lance, we have a question for you. Go ahead. Joseph, can you bring that up, a PPP question? Go ahead, Lance.
Full denial, we're waiting on result. Okay, so on appeals, after an appeal has been filed, and the difficult part of appeals is knowing if they have, because an appeal must be filed by the borrower, not by the financial institution. So you need to get proof that the appeal was filed. Once an appeal has been in process for 90 days, as a PPP lender, you can go ahead and present that for guarantee purchase and get paid on it. So, and I've done this a number of times, but the appeal itself does extend the deferment period, meaning the borrower, when the loan's on appeal, does not have to make payments. But I could be wrong on this, but I have not heard that an appeal extends the maturity on the loan. I'm pretty sure that that is not the case. So in this particular case, again, you know, I'm going to recommend identify when the appeal was filed, 90 days after that, present it for guarantee purchase, get it paid, and then it'll be between the borrower and the SBA going down the road.
Lance, I had another interesting question this week, which was the owner passed, went to the second generation, and they had this $450,000 PPP loan, and it was never touched, and they paid it back. But now they want the money back. And I said, I think you're out of luck. Let's see. Yeah,
I think that now, in the case of a sole proprietor, independent contractor, so I mean, $450,000, Bob, was probably a business.
It was. Yeah.
If the business entity still exists, the death of a owner / stockholder is not going to change things. So, I mean, it's not likely they'll get it back. But also remember, and I've done probably, in fact, Wednesday was my obituary day in PPP guarantee purchase. Once a independent contractor, sole proprietor, Schedule C filer passes, and you have proof of that, you can present for guarantee purchase on that PPP loan.
Very good. John, thank you so much for joining us. I appreciate your insights and putting things in context for us. That's very valuable.
I always love it.
We're playing around with Amazon. This went up on Amazon. We're also going to hardcover, which is on all the SOPs and what we're doing. So Michael's going to be updating that, but we're putting all of the stuff on Amazon. You can order through Amazon, and they take care of everything. Delaney, good job. Lance, it's always good to see you. Thank you for joining us today for Coleman Report Live and for supporting America's Main Street, one entrepreneur at a time.
Have a good weekend.
Thank you for joining us today for today's episode. If you like today's content, hit that subscribe button to subscribe to our channel and click that bell icon to get notified about our latest videos. Thank you again for joining us today and for supporting America's Main Street, one entrepreneur at a time. Catch you next time.